Czekamy na Jima i Jennifer. Pozdrawiam wszystkich systematycznie tutaj, podróżujących z nami w trasie do mistrzostwa w sztuce gry aukcyjnej według Jima Daltona. W tej serii akurat. O, jest Dalton Luke. To mi się podoba, są Daltonowie. To Kromera brakuje, żeby dodać.
Should be or could be the most important day from an educational standpoint that has happened during this intensive. I don't know that for sure, and each one of you will be different. But if you look at last night's report, and Jen, why don't you bring up last night's report, please?
Okay. 1 second, I'll take the screen.
And I want to look at the last part where
Okay, you want to see
oh,
the
no,
last
wait
page?
wait a minute. Now that came up on another screen.
I don't know what you mean.
It's not on my laptop. It came up on. Oh, there. Okay, I'm pulling it over. These multiple screens confuse me. Okay.
It's
so
so
we're
to
gonna-
confuse you though.
okay, so we're gonna. Are we looking at
Sorry,
your
you walked
screen?
into that. Okay, what page did you want?
Okay, let's look down towards the bottom. Keep going. The profiles.
Okay.
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 When you look, and actually, if you look at, I didn't mark it, but what is the L period high? If you can put your cursor on the L period high, please. No, I'm sorry, it must be the J period high. What is exacting high for K period, half back relative to L period? Maybe I got, oh, I probably got the wrong. Okay, look at what is it? What's the period 2 before K period? I can't see it. It's too small. Okay. Split out yesterday. Okay, I guess it's the J
Yeah, so
period- the
what
J
did you-
period high was if we had the overnight in there from the night before, it was where it filled the gap by 1 tick, if I remember right. But that was a questionable high to me. But what I really what I really want you to see is that and we can go back to the graphic now, please. If you look at the K period high is half back relative to L period. Now, we talked about this before. And then you look at the M period high is half back to L period. Now, what you had going on yesterday afternoon, and these are the things that make it very, very difficult as traders. The short-term traders were like the Pied Piper. They were just selling the market. And they were selling it from, and how do you know that? Because it's coming from those exacting levels. That's the mentality that they do. That's their research. Now, that is tough to watch when you see how far down the market goes. And you're watching it and you think, well, what good is this? Well, it tells me who was playing. It increased the odds that the market was getting excessively short. And if you look at the report last night, a short inventory condition must be considered. Wednesday's break was on slightly lower volume, with later selling beginning at exacting references. When we talk about developed trades, to me, seeing what is happening there is setting up a developed trade. I came in this morning long, but now it seems so simple. I'm talking about it, dispassionately right now. But emotionally, it was, an extremely difficult trade to do. When I looked at market-generated information, I knew what the odds favored to do. The emotional side of me, when you see the market go down as much as it did yesterday and extend on the downside, and then, it trades lower most of the night, it is an extremely difficult position to do. Now, before I talk about how I did it, I want to know if there's any questions about what I just talked about, how I saw that as getting the market too short. This is very, very important, because this is, when we talk about the fact that only a couple percent of short-term traders make money, and then usually it's not the same couple percent each year, the difficulty and the emotions involved are absolutely huge. Okay, questions on what I've talked about so far?
Okay. In yesterday's evening report, Jim highlighted the exacting highs at the K and M periods relative to half back of the previous period. I interpreted this as weak hands and therefore a level that is likely to be revisited. In this case, it wasn't. Is this the same reason that Jim pointed these out?
Absolutely. It wasn't revisited yesterday. It gets the momentum for yesterday. And the trade, they're coming in. You've got the earnings coming in, at the close. They're front running those earnings. They think they're going to be bad, and they're watching yields. They're watching yields go down or go up. And it just took on a life of its own, and that happens sometimes. They just push it and push it and push it. But at the same time, it was setting up a developer trade. I wasn't going to get in front of it yesterday. I've seen too much to know that, it's not over till it's over type of thing. And they just kept doing it. But it did set up a developed trade, not for yesterday, but for last night, for my coming in this morning. Okay, so again, when you say you interpret that as coming back there, yes, it does increase the odds we come back there, but it doesn't have to be yesterday. Okay, anything else before we go to the next stage?
Yes. Does the fact that we had the excess low in the last period before the close yesterday weaken the day time frame meaning of it just because we can consider it as only closing intraday shorts?
Well, it still has my attention. There was a possibility down there. And then I watched the overnight, and the overnight traded down below that. And I wasn't going to do anything yesterday. I did. It did look like an excess low, but I wasn't going to do anything yesterday. And remember what I said so often, the latest short overnight traders have a tendency to do what they've seen last. And what they saw, yeah, there was a rebound off the low, but they basically saw selling all in the afternoon. So I waited, and they took out the low overnight. And when they took out the low overnight is when I bought when I got up this morning and they were doing it, and that's when I did my trade. Okay, other questions?
Is the excess low in the last period yesterday, would you also consider that a spike down, or is the concept of the end of the day short covering negate the significance of the spike?
Okay, that's a great question, because I vacillated yesterday whether I write that up as a spike or not. And I elected not to write it up as a spike, but instead focus on the 200-day SMA. So you have a very legitimate question. I don't think there's anything wrong with considering that as a spike, because I looked at it and then I thought it was more relevant to stay on the 200-day SMA. Other questions?
No, we can continue on.
Okay. Now, and if you can share if you feel the emotions I felt, it's one thing to casually sit here and talk about it this morning. I wanted to go long, and you saw I wrote it in the report last night, so we're not cherry picking anything. But the question is, you're below the 200-day moving average, and there's every possible way in that you can manage here to outthink yourself. I mean, it is unbelievable, the emotional things I was going through. So I did two things. I went flat everything else I had. And then because the 200-day SMA has good chance of we're going to move up or down from there. We don't have to. I've seen it move back and forth for some period of time, but the odds were pretty good that we would move up and down. I bought the strangle expiring a week from tomorrow. And if anybody's interested, Jen, take it off. I've got to go check and to give people exactly what I did to make sure. So make sure my screen doesn't show for a second.
We're on my screen, remember, because we're showing the report.
Obviously, I don't remember. Well, you give me so much heat. I screw this up so much.
Yeah, and you having multiple monitors doesn't help.
Okay. I bought, if you want to follow this, I bought the 4370 calls for 4370 calls for 32.50. I bought the 4310 puts for 34.25. So I've got 64, call it 65 handles. away for, if you do nothing else, no trading against it or anything else, 65 handles between now and a week from Friday. So that's my initial position. Okay, then the next trade I did, because of the strangle, was just because I thought we'd have that, you know, that volatility. But the next trade I did was buy four 43.60 calls that expired today. Okay. Jen, we can go back.
You want me to give
Okay.
you the screen?
No, yeah, yes, please.
Okay, you want me to give you the screen, right? Just making
Yes,
sure.
please.
Okay. Okay. There you go.
Oh, no. Hold on. No, I've screwed up. I'm not seeing. No, take that away, please.
Okay. I had a feeling. That's why I was like, are you sure? I
All
don't
right,
know.
now I'm looking at your screen. Okay, no, we're okay. No, wait a minute. Yeah, we're okay. We're looking at your screen now. No, I didn't want the screen. I'm sorry. All right, we're looking at your screen. All right. So
Yes.
now,
Did you want the screen back? Because you asked me for it, and I'm
no, I don't want the
confused
screen.
with-
Don't give me, no matter what I say, don't give me the screen.
No. Okay, guys, you heard that. He said no matter what, he doesn't want this. What he says, he doesn't want the screen. Okay.
Okay, so there is so much involved in this. It is so important, and there's so much emotion. I'm open for questions.
Okay, somebody's asking, could you repeat what the strikes were again, please?
So if somebody remembers, I don't want to go back and look at the screen again, but if somebody remembers what I just said.
But you can, because my screen is showing, so.
Oh, okay.
Oh my goodness, Jim.
Hey, old people get,
Oh, now he's gonna use that excuse.
you're right. Okay. Long 4370 calls expiring a week from Friday. Long 4310 puts expiring a week from Friday. And then long,
Wait, 4370 calls, you said expiring next Friday, and what else?
and 4310 puts expiring next Friday.
And what was the third leg, or you had something else? You said long 4370 calls
And the
expiring
third
next
thing I
Friday.
did this morning,
Yep.
is I bought 5 4360 calls expiring today. Now,
Okay.
those calls were my tilt to the upside because I thought the market was short. The market rallied, and I then sold 5 4375 calls for $550. I paid $540. I paid $540 for the original calls, which were the 60s. As the market went up, I sold 5 of the 70s for $550. So I'm in the calls risk-free. Okay? Anything else before I leave this page?
Okay. Let me see here. Okay, somebody's asking, 4360 lines up is today's call. It lines up with one of my indicators. Jim, would you please give the reason what you saw at 4360? Why that level?
Choice. No particular level. No particular, I'm looking at the market. and I'm looking at where yesterday's, where we were, and I thought the market would rally. And that's the only reason, because it was relatively close. It has nothing to do with some indicator you might have. It was because I thought that it was close to the overnight high. The market at the time was lower. I thought it could run up there, which it has. And I thought that would give me a chance to sell the higher strike price against it. There's nothing based on exactness. Okay, anything else? The two things, Jen, I'm going back to your screen.
Jim,
Yes,
just remember you said no matter what, don't give you the screen. So we're still on my screen.
I know, I'm just telling you. Okay.
But what we're showing is the report. So I'm assuming you
I
want
understand.
people to see
No, we're
charts.
okay, we're okay. The two things that I really wanted to impart to you this morning. The importance of market-generated information yesterday. And it was real. The second was how I use options in order to control my risk, and also to control my emotions. When we went over the options the other day, emotional, mental control were a serious part of it. If I had to last night, if I had to go long the futures, I couldn't have brought myself to go long the futures. Just because knowing that anything can happen very quickly. And the risk would have been too much. I could control the risk through the options. Remember, to me, the options are a substitute purchase or sale of the underlying. So the first strangle I did expires a week from tomorrow. And I did it because we're at the 200-day SMA. And I said, okay, we've got a good chance, to make a major move relative to the 200-day SMA. We don't have to, but the odds look pretty good. And I've given myself, till a week from tomorrow for that to work. Now, understand, a lot of people don't appreciate it. They tend to think in absolute terms. Oh, does it move enough one way or the other to make that profitable? And you say, well, that's a hard move. But if it moves sharply one way or the other, so say, for example, let's say, for example, it rallies, and a strong rally, but I don't like the market generated information, I can then go out and sell higher strike price calls against the existing calls. That brings in money, that takes risk out of the trade. Or the other way, if it trades to the downside, you get a good move to the downside, I can extend the downside by selling higher or lower strike price calls against the puts, the existing puts. So never do I just take it and wait for, it to either work or not work. I trade against it. Okay, so what I wanted you to, the two things I wanted you to see this morning, I wanted you to understand that market generated information yesterday was there. That led to a developed trade for me. It was delayed, it wasn't until this morning. And I wanted you to see how I use options in order to control some of my emotional feelings. And I call it emotional risk. Okay, we've got a couple minutes till we open. Other questions?
Yes. Okay, so did you buy that 43, by the way, it was 43.70 calls that Jim had bought. Did you buy those at the end of the day yesterday and then sell? Because somebody's asking, did you buy the 43.60 at the end of the day and then sell the 43.70 this morning?
I did everything this morning.
Okay. Somebody said, I interpreted things same as Jim and saw the selling in the evening, but I have to sleep at night.
Yes, me too. And I slept at night. And when I got up this morning, is when I did everything. I had nothing on overnight. When I got up this morning is when I did the trades. But I had the information from yesterday, and then when I got up this morning, we traded down below the overnight, below yesterday's low. It was very sluggish, and that's when I started. That's when I started to do it. Okay, what else?
Okay. How funny. I bought 4 of next week's 43.50 calls early this morning when I saw the excess low around 43.20, close to the 43.17 support. And like Jim, it was not an easy buy. I sold 3/4 of them for a nice profit, but I'm on European time right now. So I'm
Okay.
I'm up early enough to catch the European action.
Okay.
Somebody's asking, so what if the market rips up?
Okay, so what if the market rips up? Okay, so I'm long. Was it the 60? I don't remember. I think I'm long the 60, short the 70s. Okay, there would be 10 points between the strike prices. I paid 40. I sold for 50. So at that point in time, if it rips up to the upside, I'm going to make 10 handles times 5. That would be 50 handles. Then the strangle, depending, that's the call side of the strangle will move up. If it moves up really sharply, I might just leave it, or I might sell higher strike price calls against the strangle, depending how far it goes. Okay. Anything else? Because I've got I've got a couple other things I want to talk about, but the market's going to open shortly. Okay. Anything else? Any other questions?
No, I think you can continue on. So you want to go back to charts? Or
Please.
okay.
Okay, so we see the you don't have.
Sorry, I missed one question, Jim. I
Okay.
missed one question. When are the matching TPOs just data points, and when are they actionable market generated information? I'm not looking for an exact answer, but maybe just some nuance to help me think about how to chunk it with other market generated information.
I'm sorry, I don't understand the question.
I think that they're asking, like, when you have matching TPOs, we always say like, oh, that's just one, that poor high or weak high or low is just one data point. They're asking, when are they actionable to actually do something about it? And I think, this person should know the answer. It depends. Depends on what, how things happen. And
it was going down yesterday. And I think when you talk about that, I guess you're talking about being the 2 periods that were exactly at half back from the other period. Okay, I'm assuming that's what you're talking about.
they said Jim mentioned the matching J highs as his market generated information along with the 200 SMA.
Well, we had the 200 SMA and we had the two 30-minute highs at exacting levels. Okay, one high is one thing. When you put 2 together, now the odds become exponential. As to when you act on that, there is no exacting answer to that. You think that you have to be able to, if you're looking for that exactness, you'll drive yourself nuts. And that's the kind of thing that will lead to tremendous dissatisfaction. You make an assessment when the odds are in your favor. And each one of us, 5 of us looking at exactly the same situation would make different answers because we're all different. And I looked this morning and I knew they were there. Remember, I wrote them up last night, so it's nothing new. And then I was there and then I'm waiting for the opportunity. And when they sold below the low, overnight low, and couldn't get any follow through, that's when I decided to act. Okay. Now, we're going to watch this. We're only an hour this morning. Is that right?
That's correct, since we've got 3 webinars today.
Okay. So now it's an inside day. The upper reference, the first upper reference would be that half back. Jen, do you have the matching 30 minutes on yours? Where did the
What
ones
did you say, Jim?
do you have on yours the exacting references I had on mine?
Which exacting references did you want put
Okay,
on
let's
here?
go. Okay, hold on. Let me get my screen up. Let me make sure I got my screen up. Okay, on the chart last night, on the report last night, what were the 2 levels that I had?
You have the 200-day SMA, the settle, the low. Are you talking about the
The matching, the exactness on the 30-minute bars.
I'm showing the report right here, Jim.
Okay, I'm on my screen. I'm sorry.
Yeah, I don't. Jim, you're
Okay,
getting way too confused this morning, and then you're confusing me.
43. Okay, that's 4367, right?
You want 4367 because that's
Yes,
right here. Hold on.
yes.
No, that level is 4366.
Yeah, the K
4366.50.
period high is 4366.50 right here.
All right, okay. And so that would be one of the references on the upside, okay?
What do you want me to
Yeah.
label it?
Just
K period. K
exacting,
period high?
exacting, half back to J period.
Okay.
Okay, now, the other one, I think we've already taken out, right? Hold on.
Yes, that would be the M period high.
Okay, so that's been traded through. Okay, now the remaining one is the K period high. Now, it doesn't have to get there. Once you take one of them out, the odds change. Okay, now, where we are this morning, we're within yesterday's range. We are at the you don't have the 200-day SMA on there, right?
No, but
No,
I can
but
put,
Jim, it's exactly at 4352.
4352.
Yes.
Okay. So why don't you
Okay.
mark? Okay. So you see what the market's doing. I mean, see, very mechanical again, right at that. All right, now. So we've got, what time does Powell speak today? Is it later today?
Uh, 12 Eastern.
Okay, 12 Eastern, which would be 9 our time, right?
Yeah, if you're 3 hours behind Eastern, then 9.
Okay, so the market's going to churn, more than likely, the market's going to churn around here, waiting to see what Powell has to say. Because that's what they're talking about on the news. Now, when I look around, the NASDAQ high this morning on the NASDAQ is just below half back from yesterday. Gold had run up overnight. Gold's come back. It's still gapped higher, but it's come back quite a bit. Crude oil is ho-hum. So the market's pretty tame in here. I'm guessing waiting for Powell to speak. Okay, and so right now it's an inside day. We are still focused on the 200-day SMA. Okay, now, hold on. Okay, now, contrary to what I said, I want to go to my machine.
You sure?
I'm
You
pretty
really
sure.
mean it? I don't know. It's okay. I'm giving you the screen.
Okay,
And we've got some questions piling up here, Jim, so.
okay. Now, here's what I want you to carry forward. Remember up here in the gap. No, there's really no excess up here. This is a non-excess day. So the market could easily come back here. Carry this forward. Don't let that get away from you. Now I'm going to go to the other extreme. If you remember a week, was it a week ago or 2 weeks ago, Friday, whatever it was, we had this huge short covering rally from here. There was no excess on the low. So that market, see how thin this was? All the way up, and it's taken back an awful lot of it. So now you've got no excess on the high. You've got no excess on the low of this large range in here. That is information you should have, that you carry forward. You should continue to remember that. It should keep you kind of mentally loose, because the market can go either way. There's no great excess on the high, meaning there's no excess on the high that shows that longer term money came in to do any serious selling. There's no excess on the low to show that longer term or investment money came in to do any buying on the low. So you're bracketed. You've got this trading range bracketed by non-excess on both ends. Almost all of the trading that's been going on has been short-term traders running the market up, running the market down. The other, I don't know where the market goes the rest of the year. Initially, I was fairly negative following that rally on that Friday. It was short covering. Short covering can weaken a market. I was fairly negative on the market. As you gain more information, you turn that negativity up or down. I've turned that negativity down somewhat because of the lack of excess on the highs that I just showed you. So now when I look at this, all I've got is a lot of short-term traders going off of yields and, you know, headline news. The longer, I don't see any, and the volume's been really low. I don't see any indication in here that the longer time frame has really done anything other than go ho hum. I don't think they know. Okay, Jen, you said you had some questions.
Okay, let me go back up here. Okay, somebody had asked earlier, related to Jim's comment on strangles, would Jim close the put side of the strangle if the market rallies? I'm just curious.
No, you're the market. Remember, they go till next Friday. They go till next Friday. There's a lot of volatility between now and Friday, and I'm playing the volatility. But what I do, if the market rallies strongly, I sell higher strike price calls against the long calls. So that takes money off the table. But too many times, if you really, where you outthink yourself, where you do yourself damage, you buy these strangles, and then the first one goes up and you get greedy, so you sell off the put side. Then the market turns around on you. And those are short-term decisions people make, and they're not good short-term decisions. Now, but I don't do nothing. I don't, if it runs up, it's not that I don't do anything. You know, I judge the market from a trading standpoint. You know, for example, when the market was going down yesterday, I had another strangle on. when the market went down yesterday, the way that went down, I didn't think it had, good chances for continuation. I thought it was too short. So I had some choices to make, and I made those choices, and I basically changed it to this. But usually the biggest mistake people make, they get into one of these, they usually get into it for the wrong reason. They get into it so they don't have to make a decision. And then as soon as it goes one way or the other, they let go of the other side. And that's not why I do it. I do it for volatility. Okay, what else?
Okay, would the H period high from yesterday be a pullback? I think they meant to say rally high reference, since it was also a week high.
You could call it that.
Okay, is value more or less important on low confidence days?
I think value is always important. It helps us sort through what's really going on. So yesterday, notice yesterday that value was clearly lower, right? At the same time, we didn't get down below this, but so value was clearly lower. They were selling clearly lower, but notice even with the value, the point of control didn't migrate lower proportionally with price. So the importance, a lot of times people don't appreciate the importance of the point of control. The point of control is the one way to think about it. It's the fairest price at which business is being conducted. And that it moved down. The gold levers, here's C, it was there, then it was here, here, and it finally came down to here by the end of the day. But when you look how much price is down here, it didn't migrate lower, commensurate with the day overall. Remember the other day when we had this short covering rally? And I screwed this one up, but look at the point of control did not migrate lower commensurate with that. And the point of control is the fairest price at which business is being conducted. Okay, other questions?
Okay. I think some other people, like when we were trying to get the references that you were going through, I think some other people were trying to name other things that they thought were references. I'm sorry with regards to some of the comments that people made, because I'm not sure, exactly what you may be referring to. At least that's what I'm taking from some of the comments here. So I'm sorry if it's something very relevant or important that you want me to ask Jim or to clarify with Jim, please type in and let me know and give the price and etc.
Keep in mind, what you see here is pretty much what I use. I use the 200-day moving average. I use areas where there's no excess. And a lot of people have all kind of esoteric references that they use. And all I can say to those people, and a lot of times people, they've fallen in love with these over the years, and they want to defend them to the death. All I can say is, if what you're doing is making you money and you're satisfied, then by all means, maintain it. If you've fallen in love with these things and you can't let them go and you're not making money, then you have to rethink everything you're doing. The next thing I want to say, what I try and do, I try and keep it simple. I try and keep it as simple as I can, because biases and cognitive dissonance are two of the real downfalls to short-term traders. And you get too many references, the more references you use, the greater the odds that you're going to get cognitive dissonance. Okay?
Okay. Could you explain again why yesterday's M period excess low was not real excess? It's not big money buying?
I just don't think it was. What was the overall volume yesterday? I think the market just got too short. Everybody, this dream, everybody's looking out for big money buying. Jen, let's look at the volume from yesterday.
Okay, 1 second. Let me. So over here, I'll take the screen back from you.
Please.
Okay.
All right, total volume yesterday, 3.7.
Well, no, I don't. No, the total volume is gone, right? Because we're already into the new day. But this was the volume from yesterday's half-hour periods here. You can
That's what I
see.
said. Total volume was 3.7 yesterday. Didn't you? Isn't that what I said? And you said, no, it's gone?
No, I thought you were going to read this number up here. I'm
No,
sorry.
no, I'm looking at the bottom. 3.7 was the total volume. Didn't even get to 4 billion. And I remember that yesterday's volume was like 1% or 1.5% or something lower than the previous day. So there was no real volume on the downside. Okay, now let's go back to my screen, please. Oh, no, 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 no. Okay.
Jim, don't play like that. Did
Well,
you want it or you didn't want it?
Yeah, I did, but I clicked on the wrong thing. Okay, we're looking at my screen. Okay.
Oh my
So
God. You
now-
got to understand that Jim jokes a lot too. And then he'll do stuff like that, like the way he's like, yeah, no. And then I don't know what he
Yeah, well,
really
Jim-
wants. Like,
Jim
I
doesn't
don't
know
think
either
I'm
sometimes.
as confused as
This dream yesterday of big money buying, everybody, that's just, everybody's looking for that all the time. It wasn't there all day yesterday. It was just a slow day. And, is an excess low? Yes. But excess can be, short covering. It doesn't have to be new money, big money buying, which is what's everybody's dream. I just don't think it's there in the market. All right, so now we're inside yesterday's range. We're still, and I said last night that I thought the biggest thing that traders would be looking at would be the 200-day SMA. And that's your back and forth in a 200-day SMA in there. And now we also said that Powell speaks, and I think the market's going to be waiting to see what Powell says. Okay, other questions?
Yes. Does Jim see the 200-day SMA as a trader's reference rather than an investor's reference?
No, what I have said is that of the 50, 100, and 200-day, and I know people use 7 days and 10 days and 200-day SMAs. I look at the 50, the 100, and the 200. And what I have said is that, in my opinion, the longer term money will sometimes use the 200-day moving average. Not all of them, but there are some investors, investment money, that does look at the 200-day. Now, remember, you have the 200-day for the market, but you also have, the 50, 100, and 200-day for individual stocks. So when I look at this, I think they have a tendency to use it more for stocks than they do for the market. But it is something I have found is more relevant for the longer time frame. I didn't say relevant, I said more relevant. It's a little fine play on words there. It's not like, wow, this is it. I'm saying there's more of a tendency. They're still trading things, but there is more of a tendency for longer term traders and longer term investors to really look at that. Okay. What else have we got?
Okay, sorry, I am an options novice. When you say that you sell a higher strike price calls against your long calls, does that reduce the holding of the long calls or it just takes in cash?
If I'm long, let's say, for example, I'm long the 10s and I sell the 20s. Okay. I now have a vertical spread. So it limits the upside of the 10. I take in cash, it reduces my risk, but it also limits the upside, because the upside, the most the upside can go is if I have the 10s, it goes to the 20s, my sell price would be 20 plus what I took in cash. So if I sold the 20s for 5, my sales price, if it went on up, would be 25. The strike price plus the amount of premium I received. Okay? So it takes in cash, which reduces risk, but the trade-off is that it kind of freezes the potential on the upside. It can only go so much. Okay?
Okay, another question. What happens if the market rips through the call strike that you sold? Do you buy back the call or are you immediately exercised with the futures? I'm trying to get a feel for the risks involved on the options sale once that option goes in the money.
Well, the future has nothing to do with it. If I'm long the 10s and I sell the 20 and it rips to the upside, you know, I'm long the 10s, I'm short the 20s. So, you know, it just goes. I can do whatever I want with it, but there's no futures involved. There's no futures involved at that point. I'm long one, I'm short the other. So it's a covered, for that purpose, it's a covered call. It's a covered right. If I'm long the underlying at 10 and I sell the 20s, it's covered. And it could go as high as it wants. Goes as high as it wants, but it's not giving me a problem. Because my sales price would be 20 plus what I took in for the premium. So if I sold it for 5, I'm long the 10. I sell the 20s for 5. My maximum sales price on the 10s would be 25. Okay.
Okay, somebody was saying, I missed the beginning of the webinar, so it may have been addressed, but is there a reason Jim didn't mark the spike and the spike base? Jim was grappling with whether or not to write up in the report, you know, if that was a spike or not. You want to?
Yeah, what I said was, yes, I certainly saw it. I thought about it, but I decided to stick with the 200-day moving average instead. Nothing wrong with using it as a spike. I saw it, I thought about it. I just decided to rather than keep the focus on the spike and the 200-day, I decided to keep the focus on the 200-day.
Okay. The question is it relevant at all that we open today exactly at the week end period high?
It could have been. It could have been that anything down below that was very questionable. So the exactness, I don't know. Basically, rather than that, basically the market opened at the 200-day. That's what the short-term traders are focused on, the 200-day. So a tick or two difference, I don't think means anything.
Okay. I'm another options novice, so sorry for this basic question. Assuming that it's only safe to sell a call when we do not expect the price to get that high, then why is it not better to just close the long call?
I didn't say I'm long the 10s and I sell the 20s. I didn't say I don't expect it to get that high, but I'm reducing the risk. I'm taking in cash, I'm extending the gain, and I'm taking in cash. Okay, anytime I take in cash, I reduce the risk of my position. So I mean, if it goes higher to 30, so what? I didn't do as well as I could have if I'd have done nothing, but I changed my risk reward by taking in cash. And I have a tendency, I do two things. The first thing I try and do is control risk. If you don't lose your capital, you always have a fighting chance. Second thing, it is controlling your emotions. Controlling your absolute cash risk and your emotional risk are the two most prominent things that are going through my mind. And if I sell a put or a call, never sell it naked. But if I sell it against the existing position, the trade-off is I limit my gain from there, but I take in cash. I take some risk out of the trade. I take some risk out of my emotions. And the biggest mistakes we usually make are emotional mistakes. Okay.
Okay. Somebody's asking, is it possible to have a written options trade example so that we can really understand? I feel I understand it, but it'd be very beneficial to have it on paper so we can visualize both sides of the trade with both the call and the put. This would probably also help in getting a better understanding. And it can just be a suggestion, doesn't have to be like a real trade, just an example. So I think like at the next option session that we're going to be having on October 28th, Jim, fair to say
Yes.
that we will do that, right? So
That
that
is absolutely correct.
okay.
It's an advanced session. It will be complicated, because this can get complicated. Okay?
Okay.
Remember, I know it's daunting from people that, really don't understand them. But the reason I use options is that it allows me to be more creative. It's market understanding times self-understanding, or market understanding plus self-understanding times your strategy. And by using the options, it allows me to be more creative on the trading. Without options and without some of the creativity, then my decisions are always all 100% black or white. And the odds don't always suggest not being 100% black or white. Like for example, this morning, as I said, I bought the I forget which strike price I bought this morning, but I remember I paid $5.40 for it. I think I bought the 50s. I don't remember. And then hold on. I'm sorry. And then the market rallied, and I immediately sold the next two higher strike prices for $5.50. So I took all my risk off the table. Now, I limited the upside, but I have no risk in the trade. So again, that just, it allows me some creativity. It allows me some mental flexibility, and that helps totally control my emotions. The biggest mistakes that I have made over the years have been emotional. Okay, what else we got?
Okay. The 10-year yield has risen above yesterday's highs. I just wanted to see if Jim feels that that's also having a downward pressure on the market.
Okay, one of the things that I've been talking about since we started this intensive, I was trying to, so many short-term traders have got themselves so totally focused on, we saw days, one tick up in yield, and you get a change in the bonds or change in the yield. Everybody's so focused on this. And what I was trying to say, markets adjust. Remember, I've been doing this for 50 years. I've operated when markets were, as I said, mortgage rates went to, I think, 19%, and the 30-year was just a tick or so under 15%. And during that period of time, markets adjusted and went higher. Now, they had great falls following that. But markets can operate. Companies can adjust to inflation. They can adjust to higher interest rates. The last 20 years have been the anomaly. They've been, different than anything I ever dealt with in 50 years. The last 20 years have been the anomaly. So all I'm trying to do with people is say, okay, rates are still really low. I mean, I remember a time when I knew rates couldn't possibly go under 8%. I just knew they couldn't possibly go under 8%. Then I knew it was absolutely impossible to go under 5%. Never could I envision they go down to 0. It was incredible. You adjust with the market. But then markets were also, up at 15%. And matter of fact, I wish I could find it. Somehow, I've moved a few times, but the day that the bonds hit the all-time high in yields. There was an article in the Wall Street Journal, and they interviewed the 4 major bond gurus. And it would have been the best time to do a bond trade because the bonds just, I mean, you know, they just sank from there. Yields went all the way down to zero. It would have been the best time in history, you know, for that trade. Not a single one of the gurus would touch it. And I wish I had that article. I've got it someplace. I just don't know where. But so again, why I bring that up is it's necessary for you to make your own decisions, looking at market generated information, looking at your temperament and risk you want to take and your strategy. One of the things that does in so many traders is listening to the news, listening to the gurus. And if you look here, what I'm concentrating on is people get very frustrated because I don't tell you where to buy or sell. I'm trying to teach you how to read market generated information, which is based on real people entering real orders. And then you make your decisions based on your strategy, based on your temperament, rather than listening to somebody in a suit tell you to buy or sell. Remember, it wasn't, if you listen to the weekend comments we put out, after that big short covering rally, you know, I think it was 2 Fridays ago or 3 Fridays ago, you know, you had these guys coming out of the woodwork. You had the one guy, remember, he's around all the time. They were immediately talking about new highs for the year. And because they take one thing, short covering, they couldn't tell the difference between short covering and new money buying. Short covering can weaken a market, and look how far we've come down. Your value, if you want to learn to really be a trader, learn to read market generated information. And that's no mystery. People say, I want to learn the profile. We're not profile traders. We only use the profile to organize the market's continuous two-way auction process. What we're trying to, you read the information, real people entering real orders. Is it complex? Of course it's complex, because there's so many different opinions. All right. Anything else, Jen?
There are a couple of questions, but we're over on time.
I've got time if you do.
I kind of don't.
Oh, okay.
Otherwise,
All right.
I would.
All right. Well, save those questions for later. We'll be back.
Yeah. So save your questions. The questions that to these 2 people, please just have them ready for when we have the small group discussion, and we can cover that. Okay.
Okay.
Sorry about
Thank
that.
you. All right.
Okay.
Bye.
Bye.